You sit at your kitchen table with the mortgage statement in your hand and you do the thing you've done 100 times. You look at the balance, you feel your stomach drop because you've been paying for years and that number has barely moved. I know that feeling because I lived it. For almost 30 years, I handed my money to people who smiled at me and I thought I was being responsible. I want to tell you something I learned too late and that you can still use starting this week. There are families living 30 miles from where I grew up who buy land, raise homes, and bury their parents without ever paying a single dollar of mortgage interest to anyone, not $1. And they're not rich. I learned this watching Amish neighbors in Lancaster County do something with money that I had been told was impossible. By the end of this, I'm going to show you a practice they've kept alive since 1875, written into their own community records, that the modern money world quietly replaced with something that drains you instead. And I promise you this, it works. Whether you're 68 on Social Security or 45 and buried in payments, it costs nothing to begin. Let me start where the shame is, because that's where the truth is too. The first house I ever bought, I was 29 years old. I sat across from a loan officer in a brown tie, and he slid the papers toward me. And he said the words that I now believe cost me more than anything else in my life. He said, just sign here and don't worry about the rest. I didn't worry, that was my mistake. I trusted that the numbers in those papers were arranged for my benefit. I assumed that if I paid faithfully every month, I would steadily own more of my home each year. That is what any reasonable person assumes. It is also completely wrong, and almost nobody finds out until it's far too late to do anything about it. Here's what I didn't understand, and what I'd bet money you've never had explained to you plainly either. When you take out a 30-year mortgage, your payments are not split evenly between what you borrowed and the interest. Not even close. In those first years, the overwhelming majority of every single payment you make goes to interest. It goes to the lender. It does not reduce what you owe. Let me give you the real numbers, because the numbers are what woke me up. Say you borrow $200,000 at 7% over 30 years. Your payment is around $1,300 a month. In that very first month, only about $160 goes toward actually paying down your house. The other $1,150 gone, interest, and it stays lopsided like that for years. After a full decade of paying faithfully, every month, never missing, you still owe over $170,000 on that $200,000 loan, 10 years. Thousands of dollars gone every year. And you've knocked off barely 15%. I remember the night I actually read my own amortization schedule for the first time. I was 41 years old. I'd been paying for 12 years. And I sat there with a calculator realizing that if I added up everything I would pay over the life of that loan, I was going to hand over nearly $200,000 in interest alone on top of the house. I was going to pay for 2 houses and only ever own one. That was the night the smile of that man in the brown tie finally made sense to me. He wasn't being kind, he was being paid. But here's what I couldn't understand yet. If this is how it works for everyone, how is it that the Amish families just down the road were buying farms, expensive farms, hundreds of acres, and not drowning the way I was? Because they weren't. I'd see a young couple, barely 25, settle onto their own land. No bank, no brown tie, no 30-year sentence. And I needed to know how. So I started paying attention, and what I found turned everything I believed about money upside down. The Amish don't borrow the way we borrow, but it's deeper than just they pay cash, because most of them don't have a farm's worth of cash either. What they have is something we threw away, and it has a name and it has a date. In 1875, in Lancaster County, Pennsylvania, the Amish formally organized what they called the Amish Aid Society. It's a real, documented mutual aid system, and it predates almost every modern insurance company you've ever heard of. The idea behind it is so simple, it sounds like a child thought of it. Instead of sending your money out to a distant company that profits from your fear, the community pools its own money and lends it to its own people. When an Amish family needs to buy land or rebuild after a fire, the money very often comes from within the community itself. Other families lend it. And here is the part that stopped me cold. When I first understood it, they lend it at little or no interest. Sometimes none at all. Because the goal of the lender is not to profit off his neighbor's need. The goal is for the neighbor to become stable, debt-free, and able to help the next family in turn. And the money circulates. It doesn't get extracted. Think about what that means. Like when I borrowed $200,000, nearly $200,000 more left my family forever in interest. When an Amish family borrows within their community, that $200,000 stays in the community. It gets paid back, and then it helps the next young couple, and the next. The same dollars build farm after farm after farm across generations. My dollars built a banker's bonus. Now, I know exactly what you're thinking, because I thought it too. You're thinking, that's wonderful for them, but I don't have a community that pools money. I can't go knock on my neighbor's door and ask for an interest-free loan to pay off my house. And you're right. You can't simply copy their society, but you can copy the principle underneath it And that principle is the thing that changed my entire financial life. The principle is this: you must stop letting interest be charged against you and start letting it work for you instead. And there are ways to do that right now with the house and the income you already have that I'm going to walk you through step by step. Because once I understood how the front loading of interest actually worked, I realized something that made me angry in a way I hadn't been before. The whole structure is designed so that you can never get ahead in the early years, the exact years when getting ahead matters most. Think about it. The interest is front loaded. That means the longer they can keep you in the early interest heavy part of the loan, the more they make. And what's the one thing the average American does every 5 to 7 years? They move or they refinance. And every single time you refinance or move into a new mortgage, you reset the clock. You go right back to month one where almost your entire payment is interest again. You restart the part of the loan that benefits them the most. I did this. I refinanced twice, chasing a slightly lower rate, feeling clever each time. And both times I reset myself back to the beginning of the interest heavy schedule without realizing it. I never once in 20 years got to the part of the loan where I was actually building real ownership fast. I kept volunteering to start over. Nobody forced me. They just made the offer sound like a gift, the same way the man in the brown tie did, and I took it every time. So the question becomes, how do you break out of this? How do you stop being the person who restarts the meter? And this is where the Amish way stops being a nice story about another culture and becomes something you can do at your own kitchen table tonight. The first thing I did, once I finally understood, was attack the principal directly. This is the single most powerful move available to an ordinary person, and the lender will never ever suggest it to you because it does the opposite of what serves them. Here is how it works. Remember that first month where only $160 of your $1,300 payment went toward the actual house? If in that first month you pay just that $160 extra, one single additional principal payment, you erase the entire next month's interest from ever existing. You don't just skip ahead 1 month. You delete the most expensive month from the back of the loan. You jump the schedule forward. When I started doing this consistently, even in small amounts, the effect was almost unbelievable. On a typical 30-year mortgage, putting just one extra principal payment toward the loan every month, even a modest one, can cut years off your loan and save you tens of thousands of dollars in interest you would otherwise have paid. One couple I read about put an extra $200 a month toward principal on a standard loan and cut their 30-year mortgage down to under 20 years. They saved over $60,000. That $60,000 stayed in their family. It didn't go to a stranger. Now, I have to be honest with you because honesty is the only thing I have to offer that the man in the brown tie didn't. When I first heard about extra principal payments, I dismissed it. I thought, I don't have an extra $200 a month lying around, so this isn't for me. And maybe you're sitting there right now thinking the very same thing. Maybe you're on a fixed income. Maybe every dollar is already spoken for before it even arrives. I understand that completely, and I'm not going to insult you by pretending money is easy. So let me talk to you directly. The person who feels like all of this is for people with more breathing room than you have. Because what I'm about to tell you is the part I most wish someone had told me when I had the least. You do not need a large sum to begin breaking this cycle. The Amish principle was never about having money to spare. Most of those families lived on incomes that would shock you with how modest they were. Their power came from direction, not amount. So here is what someone on a fixed or tight income can do this very week, with no tools, no risk, and no special knowledge. You round up every month when your mortgage payment is due, you add the smallest amount you can stand and you label it in writing for principal only. Not $10,000, $20, even $10. If your payment is $1,312, you pay $1,350 and you write apply to principal right on it or select that option online. That $20 or $40 feels like nothing. But because of the front loading we talked about, in the early years, that small amount erases interest far larger than itself. You are not paying $20. You are deleting future interest that may be 5 or 10 times that size. A few dollars now removes many dollars later. That is the closest thing to magic I have ever found in money, and it is available to the poorest person watching this just as much as the richest. And here's the second thing for the tight income household. And it costs you absolutely nothing. Call your lender or look at your statement and find out 2 numbers, your interest rate, and whether you have any prepayment penalty. Most modern mortgages do not. Most people have never checked. I went years without knowing mine. Once you know you can pay extra toward principal without penalty, you have taken back a power you didn't know you'd given away. Knowledge of those 2 numbers costs nothing and changes everything. The Amish keep meticulous household account books. They know every number that touches their money. We've been trained to look away from ours. Looking is free. But even all of this, the extra principal, the rounding up, even this is still playing on their field by their rules, just playing smarter. And I promise you something more than that. I promised you what those families have been doing since 1875, the thing the modern money world replaced and hoped you'd forget. So let me give it to you now, because this is the piece that changes you from someone fighting the system to someone who quietly stepped out of it. Here's the secret, and it comes straight from the structure of that Amish age society and the household discipline that grew up around it. The Amish don't just avoid paying interest, they flip it. They become the bank to themselves. And the practice that makes this possible has a plain old name in their tradition. They call it paying into the fund before you pay for the want. It means this: before any Amish family spends on a single thing they desire, they first set aside a fixed amount into a pool, sometimes the community fund, sometimes their own household reserve. And that pool exists for one purpose only, so that when a need comes, they fund it themselves instead of borrowing. Now watch how powerful this becomes when you turn it on your own house. Most people, when they finally pay off a debt, a car loan, a credit card, they feel the relief and they let that monthly payment dissolve back into everyday spending. They were paying $400 a month on a car, the car is paid off, and that $400 just quietly vanishes into more spending. The Amish principle says the opposite. When a payment ends, you keep paying it, but now you pay it to yourself into the fund. Here is exactly how I did it and how you can start this weekend. I had a car loan, $310 a month. The day I made the final payment, I did not celebrate by spending it. I set up the same $310 to move every month into a separate account. I never touched my own family fund. Then, when that fund grew, I used it to make principal attacks on my mortgage. And eventually, the fund grew large enough that for the next vehicle, I didn't borrow at all. I paid from the fund. Then I paid the fund back at the same monthly amount, but the interest that would have gone to a lender, I now effectively kept by never owing it. I had become the lender. The money circled inside my own family, the way it circles inside an Amish community. Nothing leaked out. This is the thing they buried. 150 years ago, ordinary people understood that you could be your own source of credit if you simply paid yourself first and refused to let need catch you unfunded. The whole modern apparatus of easy financing, instant approval, sign here, don't worry, exists precisely to make sure you never build that fund. Because a family with its own fund is a family that doesn't need them, and a family that doesn't need them is a family they cannot profit from. They didn't outlaw this practice. They did something clever. They made borrowing so easy and so normal that saving first felt foolish and slow. They replaced patience with convenience, and they have collected the difference out of your pocket every month of your adult life. The Amish never accepted that trade. They kept the patience. And the result is families with modest incomes owning their land outright, burying their elders without debt, and handing the next generation not a pile of payments, but a working fund that builds the next farm. The same dollars doing good over and over for 150 years instead of being extracted once and lost forever. So let me tell you what to do, simply so it's clear. Find one payment in your life that is about to end, or one small amount you can spare. Open one separate account this weekend. Move that amount into it every month and do not touch it. When it grows, send it against your mortgage principal with apply to principal written plainly. And the next time a need comes that you would have financed, fund it from your own pool instead, then refill the pool. That is the entire system. There is nothing more to buy. There is no course, no advisor, no brown tie. It is the oldest money discipline in this country, kept alive by people who never trusted the easy offer, and now it's yours. I think about the man I was at 29, signing those papers, told not to worry. I wasn't a fool. I was just never shown the other way. Nobody profits from teaching you to need them less. So if no one ever sat you down and showed you this, it isn't because you failed. It's because the people who could have were paid not to. You are not behind. You are not too old, and you are not too broke. The day you keep your first payment instead of letting it leak away is the day the direction of your money reverses, and it can be this week. That's not me selling you hope. That's just arithmetic, the same arithmetic the Amish have trusted since 1875. I want to be the kind of man who refuses to keep handing his family's money to people who smile while they take it, and I think you're that kind of person too, or you wouldn't have stayed with me this long. So here's what I want to know from you. When you read your own amortization schedule, and I want you to go read it tonight, how much interest are you scheduled to pay over the life of your loan? Find that number. It's on there. Put it in the comments, just the number, because I promise you, you are not the only one who never looked, and seeing each other's numbers is how we wake up together. Tell me. I read them. And if you're ready to stop being the person who restarts the meter, subscribe and stand with the rest of us who are quietly taking our money discipline back, one kept payment at a time. Because next time, I'm going to show you the exact household account book method the Plain families use to know where every single dollar goes. The one habit that lets a family on a small income outsave a family earning 3 times more. You won't want to miss the first page of it.